Hi, and welcome to Macro Monday, where we talk macro, try to make sense of markets, and they don't really make any sense. And more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today. As we have it, what happened today in the markets? Well, I can summarize that with two arrows. Yes, stocks up, yields up. Amazing how that relationship seems to hold up. Now, I want to talk about don't fight the Fed. But before we get to that, I'm sure many of you are wondering, hey, the Fed announced today that they're going to be purchasing individual corporate bonds, apparently direct from the issuers. Yes, in fact, they're going to be purchasing bonds of companies who really don't need somebody to purchase their bonds, such as companies like Apple. We're going to be buying foreign company bonds, U.S. company bonds. Seems to be no real rules or limits to what we are going to buy. Leading some people to ask is, well, does that mean the Fed is going to essentially subsidize companies buying their stock back? Well, possibly, but you have to think about this. If a company is issuing a bond to buy their stock back and the Fed buys the bond, is that where it ends? Well, no. The company still has to pay the interest on the bond, and when the bond matures, they still have to pay it off. So there is a cost. Just because someone else is entering the market, such as the Fed, and is buying that bond, does not mean that it's free for all to go out and issue an unlimited amount of debt and buy all your stock back. You still have to make the payments on the loan. So will companies do that? Remains to be seen. I guess we'll start finding out more once second quarter earnings begin. Season begins, which should start up here sometime next month. And we're going to find out, are companies coming back to the table to buy stocks with debt? If they do, that could put a nice amount of support on their equities. If they're not, it doesn't really matter if the Fed's buying them, you're buying them, or I'm buying them. Nobody really cares. Again, I think this has more to do with taking the pressure off of the corporate bond market, which is just going to continue to see a deluge of new issuance as companies look to borrow money to cover their negative cash flow. We'll see how it all plays out. Now back to the whole don't fight the Fed. So many people get this wrong. In fact, last fall, for the very first time, I wrote and taught a class sort of right around this concept of don't fight the Fed. I taught it at my local junior college, and people came. In fact, more people came than I thought would actually take this class. And I went through and I explained many of the cycles, as I've shared with you in this over the years in doing these videos. And we talked about specific investment strategies and how they relate to fighting the Fed or not. And I asked people in the room, well, what does that mean? They said, well, when the Fed is easing, you buy stocks. I said, okay. How many of you sold stocks when the Fed was tightening? Take a guess how many hands went up? That's right, none. In fact, I said, how many of you ever sell stocks? The answer is no, they don't. So they didn't sell stocks when the Fed was tightening. They didn't sell stocks when the Fed was tightening before the great financial crisis. In fact, don't fight the Fed just means don't do anything. It means, oh, everything's going to be A-okay. And when I pointed out to them all these different times where the Fed easing actually causes interest rates to go down and stock prices to go down, they were shocked. How could this have happened? And yet it very clearly happened in the first half of QE1 when the Fed was easing and it caused stock prices to go down. It happened here in March. In fact, nobody who believes in the Fed has came out and said, hey, why did March the Fed was easing and stocks went down? There must have been a glitch. Did someone turn off the market for a month? Did the exchanges, did the wires get chewed by a rabbit or something, and the order routing was going all over the place? I don't know, because QE does not do what people think it does. So when people get this don't fight the Fed belief, it just means take risk, take more risk, and don't worry about your risk because you don't need to worry about it. It's not how it works. See, it actually is just the opposite, because this relationship between treasury yields and stock prices going down will eventually happen again, no matter what the Fed tries to do to stop it. And believe me, as we know, them due to buying corporate bonds and junk bonds, they're doing everything they can to keep investors' risk appetite high, along with equity prices, because as we know, and the Fed figured out decades before, The reason they want stocks to stay up is not because Jerome Powell's worth over $100 million and wants to see his portfolio up, although I'm sure that has something to do with it. It has more to do with consumer confidence and consumer spending. When consumers have money in their pocket and when consumers think they're getting richer, what are they willing to do? Borrow today and buy today, because don't worry, I can always pay it back tomorrow because I'm going to have more money tomorrow than I do today. But a lot of people don't get how the Fed actually ends up crashing the market. And I think this is really interesting because we actually cover this every Monday when we look at how the hedge fund manager is positioned. And there's a very particular reason why I am highly interested in the short position of the Treasury bond market, because the Fed is going to squeeze these short sellers out. And a lot of people don't realize that when the Fed squeezes short sellers out during a period where there is very little dollar liquidity, to cover their shorts, they're going to need cash. Well, if there's not a lot of dollars around or the dollar is rising, that means they're going to have to sell something to get that cash. Stocks? Well, fine, they could start selling their stocks to get the cash they need, to pay a premium to get the cash they need, to cover their bond shorts. But then what would happen when they sell their stocks? What direction is volatility going to go? Because, well, we know hedge funds are short volatility, so it causes volatility to spike. Well, now I've got to cover my vol shorts as well, so I've got to do more selling, and the next you know, the machine just starts to spin faster and faster and faster and go boom. You say, well, wait a minute. How is the Fed going to do that? Well, it's really simple. See, when bonds are out on the market, when Treasury bonds are sitting out on the market, what is something investors can do with them? You know, they can go to the securities dealer, who is effectively the warehouse for stocks and bonds, and say, I'd like to short the Treasury bond market. Dealer says, hey, I'm happy to take your money. And so they place these bets on interest rates going up, right, to support their stock portfolio that they're bullish on. But what happens is the Pac-Man or the Fed comes along, it starts chewing up the supply of bonds. It gets smaller and smaller and smaller. And you say, but wait a minute, Steve, the U.S. Treasury is running record deficits. Yeah, and guess what? The Fed is buying $120 billion of these things a month plus. What do you mean? More? They can't be buying more than that. Yes, they are. Because when they do their junk bond and corporate bond purchases into these special purpose vehicles, there have to be some sort of insurance policy in case the bonds go down in value. And you know what that insurance policy is? Called Treasury bills. So they got to buy more. So the Fed gobble is chewing up the Treasury supply slowly every month. To the extent is in the 30-year bond market, if you look at just what the dealers are picking up every month, the Fed's buying about twice the amount. Remember, that's why I said this drop recently in Treasury bonds was going to be reversed because the banks needed more bonds to sell to the Fed. And look what happened. Boom, it reversed. And so what people don't realize is when the Fed next time, or as they chew up the bond market, but going into the next major spike in QE, because we're nowhere near out of this, and there's going to be another event where the Fed's going to just really open up wide and gobble. What are they going to do? They're going to pull the supply of bills, notes, and bonds out of the market. And when they do, it causes those who are short to be squeezed. And that is how, my friends, the Fed caused the big stock dump in the great financial crisis, because they squeezed the people out of the bond market under the name of trying to create liquidity. Well, they created liquidity, all right. Do you know how they did it? They got everyone to sell their stocks. They crashed the market. You want to create liquidity? You get everybody to sell. Guess what? Boom. Now you got a bunch of money in cash. There's your liquidity. And they're going to do it again. That is why, when people ask, how can you be so bullish on bonds? Because the Fed is literally going to do the heavy lifting. They're going to squeeze all these short sellers out. That's why I'm so interested in this every Monday, when we look at how hedge fund managers position. It's one of the first things I look at Saturday morning is as a Hedgeopia website. How are the sellers positioned? Because until those speculators are long, we're not at a bottom in yield. And they're not bottoming yet. We got a ways to go. And the Fed is going to continue to gobble, 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 gobble until they trigger the short squeeze. And that will happen it's happening slowly. But the next time the Fed has to crank up QE, it's going to squeeze a lot of people out. Let's take a look at the economic data. Going backwards to yesterday. This is a little old because it's May, but retail sales in Japan on a year-over-year basis. Japan was already in a recession, whether or not anyone wishes to admit that or not. But retail sales didn't rebound in May. They're still down. They were down 12.3%. We'll be interested to see how the things fared in June. Not much in the economic news today, but there's a couple things of interest. We can see on a year-over-year basis, preliminary coming out. CPI data out of Spain improved from negative 0.9 to negative 0.3. How about we've got the German CPI index going from 0.6 to 0.9, also preliminary data. So is this a sign of inflation? Well, it's a small, tiny little sign. Is it really a big deal? No, because the Fed is still easing. I mean, in the end of the day, sure, were there going to be some small blips, higher inflation? Yeah, I expected that because crude oil did rebound. Remember, it's a big part of the U.S. CPI. And so, in the end of the day, not a big deal because, again, Fed Chair Powell put a floor under QE, means the monetary base is going up and the money multiplier is going down. Let's see if there's anything else in here. Consumer confidence in the Eurozone improved slightly in June, so that looks like things are starting to get a little bit better in the Eurozone. And in Hong Kong, we saw exports a month-over-month drop a little bit more, and imports drop in May a little bit more. Again, this is May data. We know everywhere that's going to be bad, so be curious to see as the June data eventually starts to come out how things are looking. Pending home sales shot up in the U.S. 44.3%. It's almost like the system was backlogged and home sales were postponed until May and then finally went through as the economy started to reopen. On a year-over-year basis, it's still down 10%, a little over 10%, and that's back at 2011 levels, so no real change here. Manufacturing index for July, the BSI coming out of South Korea. If we click on this, it says, a reading below 100 means the number of companies that see business conditions deteriorating the month in question outnumber those who see an improvement. So again, things in South Korea as far as the manufacturing BSI index, it did improve from 45 to 51, but that isn't a big improvement. So it's something you can kind of keep a lookout for. We've got tonight the industrial production data coming out of South Korea, some preliminary data coming out of Japan, and some data coming out of China for June. So some good points that we'll take a look at on Wednesday. Now let's head over to Hedgeopia and take a look at the commitment of traders peek into the future through the futures, how hedge funds are positioned. And so we see the 10-year Treasury note very slightly long. Now, does this mean, okay, yields are bottom, this is the time to? No. It just means they're ever so slightly long. Remember, it's not until they're really long bonds, in this case notes, that we see a bottom here. So just a smidge on this chart means nothing. But let's take a look at the long bond, the 30-year. Virtually no change over last week. I mean, they were slightly less short, but this is the big data. You want to see when interest rates bottom. You want to see these green bars way up here like we did back in mid-late 2017 and back here in kind of mid-2016. So there's a lot of positions on the long bond that are still short that eventually need to be squeezed out. And if you look at my deflationary thesis and how I believe there can be a shock of rates dropping to zero and then shooting up, it's because speculators are so short the bond market. Now, granted, they're not as short as they were, but there's still a hefty amount of short positions sitting here that the Fed will slowly chew up. Again, they're based on my data, they're buying an extra $5 billion a month in Treasury bonds that is not being issued in supply. So they're buying around $10 billion a month from what I can tell. There's $5 billion of it going to securities dealers, leaving $5 billion that's got to come out of the market, squeeze. until they break. How about crude oil? No real change in WTI, as I believe that crude oil is way overpriced, and we'll see. What's interesting, if you're really following the crude oil market, is this week, so we won't see this data until next week, this is the big driving week of the summer. So most people travel over July 4th weekend or week. So we'll be very curious to see, if there's a massive amount of drawdowns in products next week. So keep an eye out on that looking forward. But I think crude is way, way too long. How about the S&P 500? We saw, look at that big drop in short position by the hedge funds. So they're backing out their short positions kind of just as the market went down. So maybe they weren't that concerned over the long move, but for whatever reason, they backed off their short positions. And let's take a look at gold, a bit of a push higher in gold futures as the market is trying to break this 1800 level and get up there. And again, I personally think it's a little premature. We'll see if rising real yields will reverse that, or if gold will take off and make me wrong about that call. We'll see. So one thing I'm not very convicted about, it could be wrong, but I don't think I'm going to be. Hedge funds were longer than NASDAQ, jumping into that crowded tech sector, and small caps, doesn't look like much of a change here as small caps rolled over. And they're still short the dollar. Usually when hedge funds get short the dollar, it starts to rally. So that's very, very interesting that we could see the dollar take off. And watch 98. We'll take a look at that in a few minutes. And how about VIX or volatility futures? They're short, but nowhere near as short as they were. But volatility is still really high. I want to look at that too today. So let's go and pull up some charts and kind of see what's going on. Let's start with the S&P 500. We drew this, and I added some more of these lines in to some other charts today. And so what we can see is buyers came in at the same point they were back in roughly mid-June and back in late May. So there was still some buying demand at these levels, pushed it back over its 200-day moving average, which is a major critical level of support, and resistance that a lot of traders and investors look at. But again, remember this kind of trending, this line here, if we see prices break down, could see a wave of selling all the way back down to the late May or March lows. How about volatility? Vol is really still elevated at 31. And so a lot of people probably are looking at volatility and say, hey, there's a lot of room for the market to rise because, we could see the VIX get down into the teens again. Well, let's zoom out to the biggest chart we've got on this. And if we kind of draw a line, and let's go and do that, I think it's sort of useful. Right here around this $31 or 31 point. I don't think you actually state the VIX in dollar terms, but you can see that this line, and here I'll make it a little bit bigger for you, is still speaking danger. So if the VIX settles up here, it could be positioned for a massive rocket higher. I mean, this is not where you want to see the VIX with stocks fairly near their all-time high. Normally when you see it come down from a massive spike, as we did, it's headed all the way back, into, say, the 15, 16, under 20 range for sure. And here we are settling up in the 30s. And if this thing finds support somewhere in here, it's setting up for a massive spike higher in volatility. And I can tell you, as someone who has played the volatility game, I am not playing that game again. Not worth it. It's very risky. Don't do it. I'll tell you that story some other day. As I promised I would eventually. Okay, let's take a look at the long bond, the 30-year. It broke through this channel, came down, found some sellers today, but still remains below its 50-day moving average, its 100-day and 200-day moving averages as well. This is a very bearish setup for yields to head lower and could very easily start squeezing out the sellers and giving at least another run back to the all-time lows, if not potentially lower, as I believe yields will likely hit zero, perhaps all the way across the curve. That would be very interesting if it does. Let's take a look at the dollar. Rallying today, still not getting through resistance. This 98 zone, is absolutely critical. Let's zoom out. And why is this 98 zone important? Because when it gets in this middle supply zone, the next move to 100 happens usually fairly quickly. And we can see past movements through supply zones between this 198 are usually pretty quick. So in a big picture scale, we could draw a big fat line here around 98 and say if this thing breaks through, it's headed to 100. The risk is it keeps going and gets out of control. So everyone's calling for the dollar to head lower. Still, liquidity conditions are tight. World dollar liquidity is nowhere near restored, suggesting to me that when it gets into the supply zone here, sellers will need to be on this, or else if they face a big move to 100. And right now with the dollar and equities, U.S. equities being fairly inversely correlated, it's not something that stock buyers want to see. How about TLT coming back to the reverse of the 30-year yield? And why did we see sellers here today? Well, remember, if we look at these two supply zones, who are up here, the buyers or the sellers? Well, the sellers, right? Because they pushed prices down into this lower supply zone where we've seen buyers. Now, at some point, as it cracked into this sell zone, what do we expect to see? We expect to see sellers. I mean, this is where they've been selling. So no surprise at some point, they finally came in today. And I did think it was going to get up to this dotted purple line first, but there were some sellers today. It's still held over its 50-day moving average, and that is still fairly bullish in terms of being above its moving averages. Now, will it come down and close this gap from last week? I don't know. It might. But remember, when this happened before, we can see over here on the left, when it finally broke through that triangle pattern, it kind of reconfirmed and then took off. Well, we're seeing the same dynamic, but the Fed has got the ball on this one because they're buying a lot of these long-term bonds. So let's take a look at high yield bonds. Again, I drew a trend line in here today, and you can see, look, it broke through that trend line last week. And despite the Fed buying junk bonds, isn't this interesting that we're starting to see the junk bond market roll over? I thought when the Fed bought things, it only went up. But yet the Fed's been buying. Remember, this is when the Fed announced it, was this day right here where it gapped up. And it's actually prices are lower than that day. So people that chase the Fed announcement higher are upside down. And this is very interesting because it suggests that high yield bonds could be rolling over and also heading lower. And there's another one I drew on, let's see. Oh, the energy sector. Because I was looking at ExxonMobil stock. And, ExxonMobil is a huge company. And they just announced performance-based layoffs. After they said they weren't going to lay people off, now they turned around, okay, well, we were going to lay off some people anyways because they were low performers. And I was looking at it and say, the trend line on Exxon doesn't look good. It looks like a topping pattern. But since Exxon is the largest holding behind, and Chevron is the second largest holding in XLE, the largest energy ETF, I thought, well, let's just look at it. And you can see I drew this trend line here. And as you're seeing this topping pattern that's about to break lower, suggesting this, again, entire move in the energy sector was all speculative move that's about to break lower and squeeze out these people who are long and potentially trigger prices all the way back down to their all-time lows and maybe lower. So this is telling me whatever's going on in the energy sector is perhaps much, much worse than we know. All right, so let's take some of your questions because I've got some interesting ones that came in over the weekend. And let's take a look. All right, first one. Hey, thanks for the awesome show. Would you please share your daily macro routine or review? Do you have a checklist for the day, week, or month? All right, that is a great question because when you watch this show, you pretty much see what I do. So we'll just start out how my day works. I start usually from bed looking at 5:30 a.m. Pacific. I start looking at usually the economic data as it rolls in between 5:30 and 6 and 7 a.m. Sometimes a little 7:30, depending on how late the data comes out. But I start looking at that. Then when I get into work, In fact, I think you mentioned, oh yeah, so we'll go on. Also, I know you use Fred, investing.com, Real Vision subscription, or there are other sources. You use a professional guide for your analysis and decisions. Good. So I go to investing.com, look at the economic data, come into work, and I usually write up a little summary. I post that on Facebook, LinkedIn, and my website. So that actually doesn't happen until market close, but I do a little write-up on it, dig into some of the more obscure data pieces like the Fed's preliminary manufacturing data. It varies between which Fed region, so I like to sometimes dig a little deeper into that, but I do that. I'll read, which was Breakfast with Dave, now Dave Rosenberg Research, excuse me. Dave, I've been reading Dave when he was free. God, man, I really wish he was free, because what a great resource it is. Kind of expensive now. At $3,000 a year. It doesn't really apply for someone who's doing things on an individual basis unless they're investing quite a bit of money. But he breaks down the macro data into much smaller bite-sized pieces at a deeper level than I go through. So I do have a Real Vision subscription. I don't watch very much of their content anymore. Real Vision has changed. Ever since they went public, they decided to come out with a lot of content, and it used to be back in the early days, there were 2 to 3 videos and then 2 or 3 research reports and 2 to 3 videos a week. And in my opinion, those pieces were so much better than a lot of what they have today. They've gone to putting out a lot of content, and back then it was just like, I couldn't wait every week to see who I was going to listen to. Don't watch as much of their stuff as I used to, but I do look for specific people. Beyond that, of course, I've got my own Fred charts that I put together. I'm trying to think. Oh, Macro Voices. So Eric Townsend does a great job. I financially have supported the show, and they have some great people. But again, I don't listen every week to what they have, but it depends on who's on there and what they're talking about. If it's of interest to me, that I'll take a look at that. And so beyond that, FinTwit, financial Twitter, I've got my cast of characters, I like to call them, who I follow on there and see what they say. And that's kind of my day. So you really kind of see here in this show exactly what I do every day. Based on the macro view we have now, you talked about being long government bonds. Yes, I'm long government bonds. You've got that. But we haven't heard you talk about taking short positions. The market, is that something you avoid? I'm interested in hearing your view on playing both sides. Yeah, I dabbled on the short side just a tiny bit. And here's the thing about the short side of the market, because I only use ETFs, is there's 2 primary reasons. One, my insurance won't really cover it for me to be short side for my clients. So I tend not to dabble in things too much that I wouldn't, use for them. I will dabble in things if I think, okay, hey, is this something that might be an option for us? I might test it out if I'm not familiar with it. And shorting the market there's lots of ways to do it. I realize that. Some of you have said, hey, you should trade options. I just don't. It's not something I understand, or do I have time to really understand? But nevertheless, I'm really not big on shorting the market, because inverse ETFs are not perfect mirrors of long ETFs, and it's something you've got to watch like a hawk. You can make a lot of money if you're on the right side, but you can lose it. If you're short and the market's rising, ouch! It can be painful. So I tend to, while I have an extreme pain tolerance, I prefer to trade things that head up. And so obviously, if you think stocks are going down, well, what's going to go down to? Yield. So how do you play that? You can be long government bonds. Last and most importantly, when is the new well-deserved take-on going to be delivered? I trust Kim's on board. Regards, poor 718 and big SVM fan. By the way, the person sent me a picture of their 718. Wow, that is a sweet, sweet car. So here's the story on the Taycan. So I did test drive it twice. So there was a first test drive. Then there was a second test drive. Now, those of you know that my son works, will not much longer, but works for the Porsche, Audi, Volkswagen dealership. So he asked me one day if I wanted to drive it again. Now, of course, I'm not going to turn that down. And the real story was he wanted to drive it. So he told his boss that he needed to bring it over to my house because the garages in my neighborhood are actually fairly tight. And he said, hey, the car's a little longer than you probably realize. I want to bring it by to see if it fits in your garage. Translation is, that's how I've convinced my boss to let me drive it to you. And so I said, well, then do I get to drive it, or is this all about you? And he says, oh, yeah, of course. You get to drive it. So I asked him how this came to be, because I didn't ask for any of this, because I knew what he was up to. And he goes, "Oh, you have an allocation to buy one, so that means you could take it out for another test drive." I said, "Well, when did I get that?" And he says, "Oh, I put you on the list." And so I said, "Okay, man, this kid really wants to drive this car." I mean, look, if I was him, I would totally do the same thing. So, so he brings the car over, and Kim's response is, "Wow, it's absolutely gorgeous. If that's what you want, totally cool with it. No big deal. I can neither confirm nor deny that she was in the car when the speedometer hit 120. Can't confirm that. All I know is the boy did get to drive it, and all I can tell you as my loyal fans is I ran the battery. They forgot to charge it that night, so there wasn't a lot of charge on it, and I wore it down enough to make sure he could only get a minimal amount of fun out of it. Of course, but he's a much bigger risk, because if he wrecked it, then he'd been in big trouble. But the build is set for January. I did have to submit a spec to confirm my test drive. But I have no financial commitment to it. I have not put one penny down, so I'm not obligated to the dealership any more than they're obligated to me. So for all I know, someone could walk in with a big chunk of money for a deposit, and my allocation will be handed to them. So unknown if the car will actually ever happen. But hey, I got to drive it twice. It's the most expensive car I've ever driven, and it was totally cool. And if I had to do that, or had to put in a build order to get one, I'd do it again. Morning, Steve, fan of your show. How do you approach going long in the market? Do you wait for certain levels to hit, or dollar cost average? During the last drop, I got carried away thinking the market would go lower and missed out on this crazy bull rally. If we do get another drop, I'd like to be more methodical about and curious how you approach it. Yeah, I'm usually an all-in kind of guy. The only reason I would dollar cost average a position, and I have done this, so you got to think, me versus as a money manager versus someone else who's not. So let's just say that your investment pool is $5,000. My pool might be $100 million. So when you think about taking, if you're investing $5,000, right? I mean, you're not going to move the market virtually in any security you can imagine, period. But when you move 100 million around, or 200 million, or 50 million, or whatever the number is, when you start putting some zeros on the end, you start being very conscious of, can I move the market in a tick? Not today, but in a tick, because you can. And I've actually witnessed high frequency traders, driving up price as my order was hitting the market and then coming back down. So I'm very, very conscious of that. So I generally trade at once, unless it's a thinly traded position where I'll dollar cost average in over a series of days. But I try to avoid thinly traded ETFs for that reason. And I also avoid high frequency trading thanks to the block desk at TD Ameritrade. So I'm generally kind of if you believe it and you're convicted in it, you just do it. So I look for trading volume. I look at that average, I think it's 5-day trading volume. Let's go take a look. I'll show you. SPY, what are we here? Trading volume. Yep, average 5-day trading volume is kind of what I like to look at. I thought that was headed lower too, but I'm not. Here's the deal. For all my detractors who you don't miss out on bull market, look, it's called the reason that you get a chance called double bottoms. Every professional money manager knows you get 2 or 3 shots. You don't buy the first one, you buy the second or third one. So either there will be a double bottom, and I would be very, very comfortable taking the risk then, or it will blow through the March lows, more likely what I think, and there'll be an opportunity somewhere deeper beneath there. All right, next. Oh, well, you know what? Let's actually, since we're at 33 minutes, let's wrap things up here. Just a little preview of what's coming up. I am scheduled to be interviewed for a Australian YouTuber's financial show. I don't know when it'll go live, but I'll let you know that. And then there's also another rumor that Chris Dark and I are going to, that he's invited me on his show, and we're going to be discussing some deeper issues that I normally don't discuss on this show. But maybe in the future we will. We'll see. There is going to be a point where I'm going to kind of open the doors and say, where do you want this channel to go? and we'll see what you want. The content of this video provides educational information only. Is not intended to provide investment or other advice. This video is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity, business express this video that do not reflect the view of Alice Financial Advisors Inc. or Steven Van Metre Financial.